Hi, everyone. Jim Kruzan here, and welcome to the third quarter capital market review. As we do every quarter, we come up with a theme, and some are a little bit easier to connect than others. This is Working Man's Blues by Merle Haggard, 1969, off the Portrait of Merle Haggard album. The reason that I chose this is, in addition to concern about the economy and where markets are, there's been an awful lot of dialogue lately about the disparity between those with assets who are thinking this is the best of times and those that are struggling, that might not have assets to fall back on and are really feeling the pinch with the labor market the way it is, as well as inflation. So working man's blues. We do these reports quarterly in an attempt to answer a couple of questions, where we are right now, and more importantly, where we're heading. As we allocate assets, we sort of have to get two things right. One is kind of where we are in the economic cycle and what the Fed's doing. Are they effectively tightening or loosening? And they can do that in a variety of ways, interest rates being one. Quantitative actions is certainly another. We've seen a lot of data over time that suggests that the economy has been slowing and it continues to do so. So this is well beyond what would be considered a normal cycle. Anyway, our agenda is pretty tight. We're only covering two issues, kind of where the economy is, and we're going to talk through a number of slides. And then at the very end, we'll also talk about the actual performance of various markets through the use of a number of indices. So we'll get an idea of what was working, what wasn't working. I've been saying for a while now, we follow the data. And eventually this data is going to suggest weakness, and then there'll be a drop, and we'll be in a recession, and that'll come as a big surprise. Or the data will start to show signs of improvement, and maybe there will be a workout without a recession. In either case, we were hoping for a bit of a broadening out, where returns would be coming from areas other than just Meg 7, which is certainly causing part of this concern that we have on high market valuations. I would have to say that this year we're seeing a bit of a broadening out. So let's start by looking at some of these slides, and then we can look at kind of how that all settled out in terms of the markets in just a few minutes. This slide you've seen a number of times before. It's the Conference Board, which is an economic firm's leading economic index. They've been producing this thing for nearly 90 years, I think, and it's never called a recession that didn't happen. Every time there's been a big drop, eventually we see a recession. This is now one of the largest drops ever recorded, second to the drop that we saw during the financial crisis. And in every case, eventually there seems to be a recession. And with the recession, a sizable drop in portfolio or market valuations. This continues to show some degree of weakness, using a filter as to, is this indicative of an economy that's improving or an economy that's getting worse? This would fall in the economy getting worse camp. We saw the most recent report, which was issued toward the end of September 18th. For the month of August, we saw that the LEI dropped again a full 0.5%. This is a long time coming should we have a recession. But I'll remind everyone that data was looking kind of ugly and certainly negative as far back as 2005. And we really didn't see a disruption in the stock market until third quarter or so, 2008. And then it was later, after the fact, painted in that the recession actually started a little bit earlier. But we're in the same boat where everything looks great, market's going higher, data looks questionable. So what data is kind of baked in the cake? Well, there's a number of different things that they look at. inflation components being one. And we can certainly see, at least here currently, this far right-hand side of this chart, that we're beginning to see an uptick again in inflation. That's a bit of a concern. The Fed is nowhere near the 2% target. And as a result, they've been really slow walking these rate cuts for fear that a much larger or more frequent set of rate cuts might actually accelerate some degree of inflation, which then becomes an even more challenging concern, more challenging problem. Because of that, there's a huge dislocation in what people think about what's going to happen with respect to interest rates. If you look at the far right-hand side of this Federal Reserve interest rate chart, you'll see that in what the curves sort of look like. If you look at the kind of bluish diamond shape, progressively seeing lower and lower interest rates, that's the Federal Open Market Committee year-end estimates. If you look at the greenish diamond, which is more of a Nike swoosh where rates are going to start to rise again at some point, that's market expectation. So you couldn't be any further off. And as a result, it's creating a lot of consternation in the bond market. And we'll see that when we look at actual indice returns. The labor market certainly is beginning to slow down. We see that in the JOLTS number. JOLTS is an acronym. I think it's job opening, labor transition. Effectively, it looks at the number of people who are quitting work to go to other jobs. That's progressively getting weaker. You're seeing that in the quits number. You're seeing flatness in the layoff number. The opening number has dropped precipitously. And whenever you see a large drop in the jobs opening, at least historically, there's been a recession. And maybe it's not as good a telltale as the LAI. It's certainly a component of that. And if you look at labor supply, that's getting challenging as well. This whole immigration policy is certainly causing an issue. In the upper right-hand chart, you'll see labor force growth. And you'll see that foreign-born workers, it's kind of a negative growth rate. Historically, they've been a large component of our growing workforce that's being removed. And then if you look at non-farm payrolls, that's the left-hand side, you'll see those are really selling off quite a bit. It's kind of a difficult time right now because the government is shut down, so we're not getting a lot of government data, Bureau of Labor Statistics and such. There was a large investment firm just this morning that suggested that had the labor numbers come out this week, they were looking at, in terms of their internal polling, a significantly weak number. That would also align itself with the fact that the Fed's decided to start cutting rates again in an effort of getting maybe a little bit ahead of the slowdown. Another real big challenge that we're dealing with is tariffs. We haven't really seen the effect yet, the bite yet in terms of tariffs. You're beginning to see some large retail chains reporting some degree of slowdown. The first couple of months, there was a huge buildup in anticipation of tariffs. So there were many retailers that had pre-tariff pricing that's transitioning into post-tariff pricing. I find this chart interesting. It goes all the way back to 1900, 100 and call it 25 years. And you'll see that where tariffs are today at about 20% across the board, you'd have to go all the way back to the mid 1930s, just after, I guess, the Great Depression, still climbing out of it, and tariffs started to come down. But we haven't seen this level of tariffs across the board in 90 plus years. And generally, when we've had high degree of tariffs and then tariffs coming down, we've seen some consternation in the market, big recessions or depressions, as we saw in the early aughts, '07. We saw again in the 30s. And another issue that's affecting bonds and also causing some concern is the level of a deficit. We're running nearly a $2 trillion deficit. This is on par with the Biden administration and looks to be somewhat the same with respect to the Trump administration. That's after Doge, that's after everything else. Some of the concerns are there are a couple of court cases that are sitting out there regarding the legality of tariffs. If those in some way got shut down, then there's a certain sizable source of government revenue that's already baked in the cake as expected to be there that won't be there. And you would see an upswing in deficits. It's starting to get challenging. If you look at the right-hand side and you look at the second chart, the lower one, you'll see right now net debt is nearly 100%. Total U.S. federal debt is 123% of GDP. Net debt is almost 100%. And by net debt, that's like we do at our household. What is our net worth? What is our total debt minus assets? That's a very, very high number. And that number is expected to rise over the course of the next 9 years, in part because of the rollout of the One Big Beautiful Bill, rollout of some of the other programs from the prior administration. Could be problematic. It already is. Our debt payments are effectively the second largest line item we have, only to get bigger. As a result of all those things, concern over tariffs, concern over deficits, concern over national debt, concern over an increase in inflation, that has caused the US dollar this year to drop by nearly 10%. One of the largest single year drops we've seen in a long, long time. That has had its own effect on certain assets, as we'll see in a minute. International securities are doing really quite well, coming off of many years where they were literally non-existent. And gold and silver also hitting new highs and having a really good year. Both of those things are performing because the backdrop is some degree of concern over U.S. economy. You wouldn't normally see that in other periods of time. But regardless, the U.S. stock market is at all-time highs. And if you were to look at this from a historic perspective, very expensive. The index level is incredibly high. The forward-looking P is, well, you'd have to go all the way back to the dot-com bubble to see it higher. Dividend yields are about the same as they were. U.S. Treasury yields are a bit lower still. So it's not a cheap market. If you look at the valuations in terms of other things, such as dividend yield, earnings yield spread, which is kind of the inverse of a dividend yield, PE, or the CAPE PE. We'll talk about that in a minute. That's the cyclically adjusted PE, or Shiller's PE. We're at very, very high highs, and we're well above the long-term average. One of those quick indices that's been used a lot lately to discuss the relative expensiveness of the market is the Buffett indicator. I won't spend a lot of time on it. It's a quick gauge as to how expensive things are. You take the total value of the market, divide that by GDP. Historically, long term, that ratio is about 70 or 80%. It goes the reason that the value of the stock market shouldn't be the sum total of the value of our whole economy, since our whole economy has a number of inputs, right? It's got all the economic output from publicly traded companies. It's got a lot of economic output from governments, federal, state, local. They pay salaries, they have vehicles, they occupy buildings and so forth. And the biggest source is small private companies, firms like mine, or firms as large as University of Michigan Med, 20, 30,000 employees, all contributing to GDP. As of June 30th, that value was 217%. Or in other words, the total value of the stock market, publicly traded US stock market, is now well over 2 times GDP. That's pretty frothy. If I were to take a snapshot today, I don't have the slide, but as of last week, it was something like 219%. This is what it looks like going all the way back to the 1950s when Buffett first created that. We're well over 2 standard deviations removed. That's 2 standard deviations removed from the long-term trend at all-time highs. And in the past, whenever you've seen these kinds of elevations, these stretches in value, at some point it gives way. And it's usually not a horrific recession. It's just a soft recession or slowdown. That kind of killed the dot-com bubble. That also somewhat killed the high elevations that we had with the Nifty 50 stocks back in the late 1960s. So this is somewhat problematic. Now, some people will look at this and say, yeah, but when you buy a public stock, that stock might actually have international operations. Those things don't show up in our GDP. So maybe these numbers are skewed. Well, factoring all that in, doing kind of back of the envelope math, that ratio should be more like 190 as opposed to maybe 217. Still way above historical norms, really quite stretched out. Academics also look at another bit of data, this Shiller CAPE index that I just mentioned, as a way of measuring valuation as well. They think it's a better measurement because it doesn't tie things back to GDP. So it just simply looks at corporations and their earnings derived from anywhere. And you'll see the Shiller PE ratio is currently just a hair under 40. It's the highest we've seen in nearly 25 years. The only time, by the way, it's ever been higher than it is today was December of 1999, just before the explosion of the dot-com bubble. We haven't seen it that high since. Now, a couple of things about the Shiller index, which satisfies the concerns of the Buffett index, is one, they smooth out the earnings because corporations can play games with earnings year over year. A halfway decent accountant can take an expense, figure some way of capitalizing it, showing it on a balance sheet as opposed to a income statement. Large tech companies do that all the time with salaries. They don't pay cash, they give out in stock. That certainly helps skew their profitability. So they smooth it out over 10 years. So it's a 10-year cyclical earnings PE. The other thing they do is they inflation adjust the numbers as well. The beauty of that is you can look at the Shiller index from 1929 and you can compare it and extrapolate data comparing it today. Otherwise, S&P or anything else that isn't inflation adjusted, clearly valuations are higher today than they were a decade ago. In fact, if the market's up 3, 4, 4% a year over 20 years, you're going to see a huge growth rate. You back out inflation, not really a whole lot of growth. So this takes into consideration that, and these valuations are really, really high. The reason it makes sense to consider looking at this is simply this. When you have really high PEs, as we have today, and then you look at forward-looking returns for 1 and 3 and 5 years, they tend to be really low. In the far right-hand side, you'll see forward PEs in subsequent 5 years. So whenever we see a PE that's close to where we are today, call it 23 times earnings, the 5-year annualized return rate is nearly zero. Now, that doesn't mean we're going to earn zero each and every year. It could very well be that somewhere in there we see a big drop in the market and then a recovery and we're back to where we were. So by avoiding the drop, we're ahead. By investing in other areas, we may be ahead as well. But it's something to consider. And that has been derived over many years. I think that's 100 years of data. Why is the market so expensive? Well, part of it is this huge concentration risk we have in that a lot of the wealth is concentrated around just a handful of names. Back in the dot-com heyday, the top 10 names amongst the S&P represented about 20% of the index. And that was thought at the time to be a very high concentration. Today, the top 10 names in the S&P represent 40% of the index. A concentration risk 2x what it was. And you can see that here in terms of top 10 names, what those PEs are relative to the S&P, earnings concentration, et cetera. I do the math as well. And what I always look at is the allocation of the individual stocks to the S&P. So what that says is the big seven, the Mag 7, represent just under 35% of the index. That's really high. And the top 10 names represent over 40% of the index. But we're still getting this bias towards some of these names, at least more recently. If we look at September as an example, September was up 4.2%. Those Meg 7 represented over 3% of the S&P return, or over 70% of the return came from those 7 names. If we look at the quarter, it was kind of much the same. The S&P was up 7.7%. Those 7 represented 5.9, we'll call it 6% of the return, or 76% of the return came from those 7 names. When we stretch out over the course of a year, it changes a bit. Those 7 names represented just a hair less than half the market. And why is that? Well, part of the reason is we're seeing an impact of this concern over deficits and debt levels and tariffs, et cetera. So we're beginning to see things like the international markets, as defined here as EFI, and you'll see it up 24.5% year to date compared to this Mag 7 induced S&P 500 up 13, as you can see at the top of the page. Or look at gold, up, we'll call it 45%. And over the same period of time, we're not seeing a ton of return on things like short duration treasuries, which are up 1% or so. And you'll see that bonds generally for the month as well as the quarter really didn't perform very well. So if you're in a balanced account, 60-40, kind of equally weight, so you're avoiding some of this risk of Mag 7, most indices are up 6.5. Not great, but certainly positive. And that is indicative of some of the concerns that we have with a number of aspects of the economy. Last point I wanted to make is that there might still be a little bit more juice in the international markets. They just generally have performed a bit better. Here's the S&P, this dark right here. And you'll see Japan, Europe performing better. That's on nominal basis. When you add back the currency fluctuation, it's even better still. And last but not least, Eurozone, emerging markets, cheap. That's relative PE. The average PE, long-term where we are today versus the PE that we're seeing today on the S&P. Would you rather buy earnings at 11 times earnings versus 22 times earnings is kind of the issue. So we're going to watch that and see if that continues. I suspect part of the improvement is a function of the weakening dollar, which may very well continue to weaken for a bit. So we're trying to stay nimble, trying to be engaged, trying to participate, but at the same time, provide some protection, because through the lens of, is the data showing improvement or not, with the exception of look at how wonderful the market is, the data is certainly questionable. And speaking of questions, if you have any, please reach out to us at our number here or email us. We'd love to hear from you. And as always, thanks so much for your consideration and your support. We look forward to having another one of these at the end of the quarter, probably in January after the beginning of the new year. I'm Jim Kruzan, and I wish you a fun day. Take care.